Good morning. It's Friday, April 7th, and we have our next series in the SAS update videos. This week the market started out at 20,700 points on the Dow. It's currently at 20,700 points, so sort of like last week, this week has been a little volatile, not too bad, but basically the market's where they were before. Both the Dow, the S&P 500. The biggest economic news to come out this week was the jobs data. And so you can look at the headlines differently. One headline I saw this morning said, U.S. job growth is sharply in decline. And so the U.S. added 98,000 new jobs in March. But the unemployment rate is its 10-year low at 4.5%. So it's sort of a good news, bad news situation. Jobs data comes out regularly, and it's open to interpretation. And it's just one of many economic data points that forecasters use to try and figure out the direction of things. I think one thing working against it right now is that expectations for job growth are quite high because of the Trump administration's promises through the election campaign. And of course the Fed is watching that very closely as well as they make interest rate decisions. So it's something to keep an eye on. It's nothing to make decisions with at this point. I think if you start seeing the unemployment rate go up, that means people are getting laid off. And that's, in my mind, a bigger indication of the economic conditions than new jobs. You just don't, I mean, new jobs in March could be different in June, or it could be different in October. You know, it's hard to predict that. But as long as we don't see a trend in a certain direction, I think that's good news. And of course, we'll cover that here in a minute. SEI has released this week their first quarter economic update. They have a long version and they have a short version. The long version has a lot of detail for those that like to go into it. The short version is more just bullet points. And it comes out once a quarter, and we use it in account reviews and to sort of shape our viewpoint through SEI's eyes of what their expectations are. In some cases, it can kind of give you an idea of what they're doing from an investment management standpoint. So as our investment management partner, we find it important to pay attention to. At the end of each outlook, long and short version, SEI gives their viewpoint. So I'll hit the highlights of that. Their viewpoint is that U.S. stock valuations, so the valuation of a stock, the price, are modestly high right now. And it creates, in their words, modest concern. So what that means is the earnings of the company might not, just in historic relation to the price, might be a little bit off, meaning the price might be a little bit high for the earnings, which that happens at times. And in some cases it's an indicator that we might have a market correction sometime soon. Because remember, you only invest if a company's making money. So if a friend comes to you and says, hey, I want you to invest in my business, the first question you should always ask is, how much money are you making? Because that should equal how much that business is worth, which should equal how much you're willing to invest. It's no different with publicly traded companies. So when we see stock prices a little bit high, it in some cases indicates a correction might be looming, because when they're efficient, the earnings and the price, the ratio is somewhere around 15 historically. So that being said, from a stock market standpoint, we expect market corrections every 1 to 2 years anyway. So we haven't had one since January of 2016. It's been a year. It's somewhat due. From an economic data standpoint, inflation is just a huge indicator right now, and everything is seeming to hinge upon that according to SEI's outlook. As long as inflation is able, according to SEI, is able to stay at a relatively modest, normalized level, we should still continue to see some economic expansion. The Fed's paying this, they're basing their decisions in the same manner. If we start seeing a higher rate of inflation, we might start seeing interest rates go up more rapidly, and that could trigger some sort of economic recession. Right now, inflation is pretty modest, so that's not of grave concern. And the last thing to note is the markets tend to be forward-looking indicator of where the economy is headed. So hopefully, if history proves to be accurate, with the market growing the way it has over the last several months or several year and a half in its rapid manner, the economy should continue to improve and expand. So in terms of SEI's outlook, not a lot has changed since the last quarter, basically since Trump's been elected. And lastly, we'd like to cover a financial planning topic in these videos, and this is more investment management, but it's something that's coming up regularly, and that is tactical versus strategic investment management. Tactical investment management is the idea at the core, it's the idea that you can be in something when it's good, out of something when it's bad. For instance, stock market's doing well, I'm in the stock market starts doing bad, I get out of the stock market. Market timing. Or even it could be from if U.S. companies are doing well and international companies are doing poorly, and you're in and out. Money's in motion constantly. Tactical money management is often what people think of when they think of investments. And frankly, it tends to be very dangerous, and sometimes it's almost even gambling, because it's so hard to predict this stuff, and the results tend to not be very good over a long period of time. With tactical money management, you can make 5 right decisions, make 1 wrong decision, and you lose. So the alternative to that is more of a strategic style of investment management, which is more buy and hold, which is the idea that I can't predict this stuff, we can't predict this stuff, smart advisors, economists, you name it, can't predict where things are going in the short term in particular. And so you diversify, you own lots of different asset classes, and you stick with them through the good and the bad, that ultimately over a long period of time you gain a acceptable level of return. And that should be a decision between the advisor, in a lot of cases here, us, and you. How much risk do you want in the portfolio? How much volatility can you accept? And over time, the portfolio will go up and down, but we want to see some growth, some steady growth through strategic money management. And we take a lot of the timing, the investment manager risk, you name it, that exists with tactical money management out of the equation. We'd love to talk more about that. It gets much more detailed than I'm able to describe in this video, but it's something important to note. We are more of a strategic, or we buy into the strategic philosophy more than we would the tactical. And so, interested in your thoughts. Would love to hear your comments. Thanks for watching this video. Hope you had a great week. We look forward to next week, and have a great weekend.